right now, there's a highly sophisticated AI autonomously hunting international money laundering syndicates across multiple borders.
Yeah, which is incredible on its own.
Right, but at the exact same time, the company building the physical silicon to power that AI is practically popping champagne because they are throwing away, only 15% of the product they manufacture.
It's a wild disconnect, honestly.
It really is. So welcome to the invisible scaffolding of the global economy. Today is Thursday, July 23, 2026. And we're taking you past the polished consumer tech and the sleek app interfaces to examine the absolute bedrock of how the world actually functions.
Because that paradox you just laid out, it captures the current moment perfectly. We had this hyper-advanced ethereal software layer, and it's sitting on top of a physical manufacturing reality that is incredibly messy.
Messy and constrained by actual physics.
Exactly. Brutally difficult to scale. So today, we're dissecting a blockbuster week of corporate earnings and market movements from three entities that form this scaffolding. That's Intel, NASDAQ, and RTX.
And I'm looking at a massive stack of sources here for you. We've got financial reports, technical market analyses, press releases, and the mission for this deep dive is to extract the signal from the noise.
We're definitely not just reading balance sheets today.
No, definitely not. We're going to explore the mechanics behind Intel rebuilding the physical architecture of AI, then dissect how NASDAQ is fundamentally rewiring the financial system, and finally analyze how RTX is attempting to navigate this unprecedented global demand for aerospace and defense.
Especially when their supply chains are strained to the absolute breaking point.
Right. So, okay, let's unpack this, starting with the literal sand that everything else is built upon. Let's look at Intel.
The Silicon Foundation.
Exactly. Heading into their Q2 earnings report, which drops today after the closing bell, the market has been pricing in a major narrative shift. On Tuesday, we saw Intel's stock surge 8.4%.
Closing at 105.45.
Closing at 105.45. Yeah, 105.45. And that's their biggest single-day jump in months. The technicals show three distinct, verifiable catalysts driving this. And the first one revolves entirely around a massive upgrade to their Xeon 6700P processors.
Right, and the Xeon 6700P upgrade is really a masterclass in identifying and eliminating the most critical bottleneck in modern computing.
Which is memory, right?
Yes. The new processors are moving to support 8,000 megatransfers per second RDM memory. And for context, the industry standard has been hovering around 6,400.
So that's a pretty big jump.
It is. That numerical jump translates to a 20% increase in total memory bandwidth, 25% faster overall speeds, and a crucial 6% drop in latency.
And production is slated for the August to September timeframe of this year, right?
Correct. Late summer, early fall.
Let's contextualize why that memory bandwidth metric is like the entire ballgame right now, because we see so much focus on the processing units themselves.
The GPUs always get the glory.
They do. But instead of that old highway analogy people always use for computing, let's look at it like a high-end commercial kitchen.
Oh, I like that.
Yeah, so your GPU, the processor doing the heavy lifting for AI inference, is your executive chef. And you can hire the best executive chef in the world capable of cooking 50 dishes a minute.
Right.
But the memory bandwidth, that's your team of prep cooks. If those prep cooks can only chop onions fast enough to supply 10 dishes a minute, your executive chef is just standing around waiting.
That is the exact dynamic playing out in hyperscale data centers right now. AI inference, which is the process of a trained model actually generating a response or making a decision based on new data, is notoriously memory-bound.
Starved for data.
Completely starved. By jumping from 6,400 to 8,000 megatransfers per second, Intel is essentially doubling the size of that prep cook brigade.
Wow.
Yeah. Pushing that data 20% faster fundamentally alters the unit economics of an AI data center.
Because, if the processor isn't just standing around waiting, it's utilizing its power more efficiently. And that has to drive down the cost per query.
Absolutely. When you are operating AI at scale, serving hundreds of millions of user queries a day, a 20% efficiency gain in inference throughput saves millions of dollars.
Just in electricity and hardware depreciation alone.
Exactly. It lowers the barrier to entry for deploying complex models. Intel focusing on the memory interface rather than just, raw core clocks shows they understand where the actual pain points are for their enterprise customers.
Which flows perfectly into the second catalyst driving this pre-earnings surge, and that's their expanding relationship with Google Cloud.
This one is fascinating.
Yeah, the sources detail that Google Cloud is deploying Gemini Enterprise across Intel's internal operations, So they're engineering, supply chain, corporate functions.
Right, but it's not a one-way street.
No, exactly. It isn't just Intel buying a software license. Google Cloud is simultaneously acting as a client for Intel's foundry business.
And the structure of this deal is highly indicative of where enterprise tech is heading overall. We're moving away from traditional vendor-client dynamics and moving toward deep symbiotic integration.
Like a true partnership.
Yeah, Intel is opening up its internal data silos to Google's AI suite to optimize how they design chips and manage their incredibly complex supply chains. In return, Google is committing to use Intel's manufacturing facilities to print custom silicon.
It's an ecosystem approach. They are embedding themselves into each other's core operational framework. So, like, if Gemini makes Intel's chip design process 10% faster.
Google gets its custom chips out of the Intel foundry faster.
Right.
And that operational integration provides a massive competitive moat. When your AI partner is also your manufacturing partner, the feedback loops are incredibly tight.
How so?
Well, say Google engineers realize a specific custom chip architecture would better optimize their Gemini models. They can work directly with the foundry printing those chips to adjust the physical layouts.
Because they're already integrated at the operational level. Okay, that brings us to the third catalyst, and frankly, this is the one I'm having the hardest time wrapping my head around.
The 18A node yields.
Yes. The sources indicate Intel secured a massive manufacturing commitment from a major cloud service provider for their 18A process node. And the big headline number here is that yields for this 18A node have jumped from 65% to 85%.
Which is a huge leap.
Sure, but wait, I look at that 85% figure and I see a glaring problem. You are running a precision manufacturing business, right? And 15% of your output is defective garbage that goes straight into the bin.
Yeah.
Why is the market celebrating a process that fails nearly 1 out of every 5 times?
What's fascinating here is that it feels completely counterintuitive, especially when we're used to manufacturing standards in other industries where, a 1% defect rate is catastrophic.
Right. I mean, car manufacturers would panic over 1%.
Exactly. But semiconductor lithography at the angstrom level, which is what this 18A node represents, is arguably the most complex manufacturing process ever devised by humanity.
The scale is just absurd.
You're printing billions of microscopic transistors onto a single silicon wafer. The physics are incredibly unforgiving. I mean, a stray particle of dust, a microscopic variance in the chemical resist, or even a tiny fluctuation in temperature will kill a die.
But surely the goal is 100%, or like at least high 90s,
Yeah.
right?
Well, the theoretical goal is always 100%. But the economic reality is governed by cost curves. At a 65% yield, which Intel was reportedly struggling with in earlier testing phases, the cost per good chip is astronomical.
Because you're throwing away a third of the wafer.
Right. You're amortizing the massive cost of the whole wafer, the energy, and the machine time over too few usable products. It's economically unviable to sell those chips to a third party. You'd lose money on every order.
Okay.
But the jump to 85%, that is the tipping point where the math suddenly works.
Okay, I understand crossing the profitability threshold, but I have to push back here on the competitive landscape. PSMC, who dominates the global foundry market, reportedly has yields for their competing N2 technology hovering around 90%.
That's the current estimate, yeah.
So if I am a major cloud service provider looking to manufacture custom silicon, why on earth would I sign a massive contract with Intel at an 85% yield when I can go to Taiwan and get 90%? Is Intel just slashing their prices to undercut TSMC?
Price is a factor, sure. But the primary driver here is supply chain security and geographic diversification.
Ah, geopolitics.
Exactly. The global tech industry has realized the systemic risk of having 90% of the world's advanced logic chips manufactured on a single island in a geopolitically tense region.
It's a massive single point of failure.
A completely unacceptable one for the major cloud providers. Whether it's Microsoft, Amazon, or Google, they simply cannot risk their entire future hardware roadmap on that single point of failure.
So they are willing to accept slightly lower yields and maybe slightly different cost structures simply to ensure a second source exists on U.S. or European soil.
Precisely. And furthermore, the 18A node isn't just a slight iteration. It introduces entirely new transistor architectures.
Like what?
Well, it utilizes ribbon FET, which is a gate-all-around transistor design that allows for much better electrical control than the older FinFET designs.
Okay.
And it also uses PowerVia, which actually delivers power to the transistor from the back of the wafer rather than routing it through all the complex signal wires on top.
Oh, wow, so it's a complete redesign of the plumbing.
Exactly. Achieving an 85% yield on a process that completely reinvents power delivery and transistor structure is a monumental engineering feat. It proves to the market that Intel's foundry roadmap isn't just theoretical marketing material.
And the market doesn't have to just take Intel's word for it either, which is probably the most compelling part of the setup. The sources highlight a massive confirmation from a third party.
ASML.
Yes, ASML. On July 15th, they confirmed that Intel is their first customer utilizing high-NA EUV for volume production, specifically targeting those Panther Lake chips.
And ASML confirming this on their own earnings call is the ultimate validation, because ASML manufactures the actual lithography machines that make advanced chips possible in the first place.
Right.
We're talking about high numerical aperture extreme ultraviolet lithography, specifically their new 0.55 NA scanners.
Okay, let's break down the mechanics of what high NA actually accomplishes, because 0.55 NA sounds like really deep technical jargon. We are just talking about the optics, right?
Yes, it is entirely about optics and light. EUV lithography uses a plasma to generate light with a wavelength of 13.5 nanometers.
Which is incredibly short.
Very short.
Yeah.
And you bounce this light off a series of highly polished mirrors to project the blueprint of the chip onto the silicon. But as we try to print smaller and smaller features, the traditional 0.33 numerical aperture lenses started experiencing optical distortion.
The lines would blur.
Exactly.
It's like trying to use a thick Sharpie to draw a highly detailed map.
That's a perfect way to look at it. Yeah. Moving to a 0.55 NA scanner means the lens has a wider aperture. It can gather light at steeper angles.
Okay, so it gets sharper.
Right. In the physics of optics, a higher numerical aperture allows you to project a higher resolution image. It allows Intel to print those microscopic ribbon-fed structures in a single exposure, rather than having to use complex, error-prone double patterning techniques.
Wait, what's double patterning?
It's where you try to print half the pattern, realign the wafer perfectly, and then print the other half.
Oh, that sounds like a nightmare for quality control.
It is. So avoiding that eliminates a massive source of potential defects, which probably plays directly into how they achieve that 85% yield on the new nodes.
That makes total sense. So looking at the technical setup heading into the close today, the stock is pinned between the 50-day exponential moving average at 106.94 and the 100-day EMA at 108.55.
Pinned right in the middle.
Yeah. The RSI is sitting at 56.3, and the options market is pricing in a massive 12% volatility move post-earnings. Consensus estimates are $14.4 billion in revenue and 22 cents in earnings per share.
And while the headline revenue and EPS numbers will grab the initial algorithms, human analysts are going to be laser-focused on the foundry details today.
What specifically should we be listening for?
Listen for any disclosure regarding the identity or specific volume of that 810A cloud customer. Also, a firm reiteration of that 85% yield metric and any forward guidance on external foundry revenue.
The market wants proof that the invisible scaffolding of American chip manufacturing is finally structurally sound.
Exact.
Now, the sheer physical complexity of manufacturing those chips is staggering. But once you yield that silicon, once you have that raw compute power, you need a software and capital infrastructure capable of utilizing it.
Right. You need a system to organize it all.
Exactly.
Okay.
Because the data centers running those 8,000 MT Xeon processors aren't cheap. They require billions in capital formation, and they require highly sophisticated software to manage the transactions. And that brings us logically to our second source, Stack NASDAQ.
NASDAQ's Q2 results fundamentally challenge the legacy perception of what an exchange actually is.
Yeah, most people still picture trading floors and ticker tapes.
People shouting over each other on the floor. But the reality is that NASDAQ reported $1.5 billion in net revenue, up 15%. But the crucial metric here is their annualized recurring revenue, which hit $3.3 billion.
ARR is the holy grail for modern tech companies. It means they are moving away from relying purely on the transactional volume of stock trades, where you're totally at the mercy of market volatility, and moving toward highly predictable, subscription-based software services.
Right.
And the sources show their annualized SaaS revenue increased 12% and now accounts for 38% of their total ARR. Their overall solutions revenue is up 17%.
They are executing a massive structural pivot. NASDAQ is rapidly evolving into a sprawling fintech and regulatory technology giant.
They're becoming the plumbing.
Yes, they are providing the underlying operating system that banks, brokerages, and international regulators require to function securely. And the crown jewel of this sauce pivot is a division called Verafin.
Verafin is their financial crime management technology. In Q2 alone, they signed 47 small to medium banks and 6 massive enterprise deals.
Which is huge adoption.
It is. They currently have 750 global clients utilizing what the sources describe as their agentic workforce. And I want to zero in on this term for a second. We hear AI thrown around as a buzzword for everything from autocorrect to search engines.
Right, it's everywhere.
But agentic AI implies a completely different architecture.
It does. Traditional rule-based algorithms, which is what legacy anti-money laundering systems rely on, are rigid.
Like basic if-then statements.
Exactly. You program a rule. If a wire transfer exceeds $10,000 and is sent to this specific list of countries, flag it for human review.
But the criminals obviously know these rules.
Of course. So they send 15 transfers of $9,000 to unlisted intermediate accounts. And the legacy system sees nothing wrong.
But an agentic AI operates differently.
Very differently. An agentic AI is goal-oriented and autonomous. You don't give it rigid if-then rules, you give it a mandate.
Identify complex laundering typologies. Wow, so you just set it loose.
Pretty much. The AI agent actively hunts through millions of ledger entries. It can proactively query external databases, map out complex corporate ownership structures, and identify behavioral anomalies that no human analyst would ever have the time to correlate.
Here's where it gets really interesting. It's like a modern casino. People focus on the gambling floor, which is the exchange, but the real technological marvel is the eye in the sky and the vault security. Verafin and their surveillance tech are tracking every single anomaly.
That's a great analogy.
And the true power here isn't just the software, it's the data it has access to. The sources note this agentic workforce is backed by consortium data exceeding $13 trillion in combined assets across more than 2,800 financial institutions.
And that consortium data is an impenetrable competitive moat. Think about it. If a criminal syndicate pilots a novel fraud scheme against a regional bank in Europe, Verafin's AI analyzes that attempt.
Okay.
Because it is connected to a $13 trillion global data set, the AI instantly learns the behavioral fingerprint of that attack.
So it adapts globally.
Yes. It dynamically updates the defensive posture for a mid-sized credit union in the American Midwest before the criminals can even target them. It operates across silos that traditional banking infrastructure normally keeps completely isolated.
It's a self-learning financial fortress. That's wild. But even as they build out this massive SaaS business, their traditional exchange operations are breaking records too, despite a macro environment heavily impacted by high interest rates and inflation.
Right.
Their index ETP assets under management surpassed $1 trillion for the first time, seeing $109 billion in net inflows over the last 12 months.
And that exchange dominance is most evident in their listings business. They captured the SpaceX IPO, which raised $86 billion.
Which made it the largest IPO in exchange history.
Unprecedented scale.
Let's pause on the SpaceX IPO for a second. We are in an era where venture capital is incredibly cautious. Interest rates make the cost of capital high.
Yeah.
So, with so much talk about economic uncertainty, how is NASDAQ casually executing an $86 billion IPO in this environment?
Well, it illustrates the concept of market bifurcation. Liquidity hasn't evaporated. It has simply become hyper-selective.
Okay, what do you mean by that?
In a tight monetary environment, institutional capital is not going to take a risk on, say, a slightly better CRM software company. But there is a massive pool of pent-up capital waiting for what we call generational innovators.
Companies that aren't just iterating, but fundamentally shifting the paradigm of physics or economics.
Precisely. SpaceX completely redefined aerospace launch economics with reusable rockets and is cornering global telecommunications with Starlink. When a generational asset like that becomes available to public markets, the capital flows instantly.
The demand is just there.
Yes, and NASDAQ's infrastructure handled that $86 billion capital formation seamlessly, and it wasn't a one-off.
No, they captured Cerebras, too, which was the largest semiconductor IPO ever.
And Quantinuum, the largest pure-play quantum computing IPO.
Yeah.
Plus the SK Hynix ADR. They achieved a 74% win rate for new operating company listings.
They are undeniably the preferred venue for deep tech capital formation right now, but they are also looking at how that capital physically settles. The courses highlight a fascinating proof of concept regarding tokenization.
The Canton Network project.
Yeah. NASDAQ's Capital Markets Technology Division utilized a platform called Calypso to execute tokenized collateral trades on the Canton Network with 2 leading asset managers.
This is a glimpse into the plumbing of the future financial system. Because to understand why this matters, you really have to understand the friction in legacy settlement.
How does it work currently?
Right now, if two massive institutions want to trade a traditional financial asset like, say, using a money market fund as collateral, it operates on a T+2 or T+1 settlement cycle.
Meaning the trade is agreed upon today, but the actual asset and the cash don't legally change hands and settle for a day or two.
Correct. And during that settlement window, there is counterparty risk.
Because one side could default before the settlement finishes.
Exactly. Multiple intermediaries, like clearinghouses and custodians, have to reconcile their independent ledgers to ensure the math matches up perfectly. It is highly inefficient.
And it requires massive amounts of capital to be locked up as a buffer.
And it's prone to errors.
So how does the Canton Network and tokenization via Calypso solve that?
Well, tokenization takes that money market fund and creates a digital representation of it, a token on a blockchain network. And the Canton Network is designed specifically for institutional finance, prioritizing privacy and compliance.
So it's not like a public crypto chain?
No, not at all. By using Nasdaq's Calypso platform, these asset managers were able to execute a smart contract. The asset and the collateral move simultaneously, instantly, on a single shared ledger.
The settlement goes from days to seconds.
Instantly.
It entirely eliminates the counterparty risk and frees up all that buffer capital to be deployed elsewhere. Nasdaq is effectively building the bridge between the old fiat rails and the future of hybrid tokenized markets.
They want to own the highly regulated, secure pipes through which the future of global finance flows.
Which brings us to a critical inflection point. Nasdaq is organizing the capital. We saw $86 billion flow into SpaceX, highlighting the massive appetite for aerospace innovation. But that capital has to translate into physical hardware.
You can't fly a token.
Right. You can have all the AI processing power and all the tokenized capital in the world, but eventually someone has to physically forge the titanium and assemble the jet engines.
The physical constraints.
Yes, and that constraint perfectly sets the stage for our final source stack, RTX.
RTX, formerly Raytheon Technologies, is an absolute colossus in the aerospace and defense sector.
They really are.
Their Q2 results are a masterclass in the realities of heavy manufacturing during a period of unprecedented geopolitical and commercial demand. They reported $24.7 billion in sales for the quarter.
Which is an organic increase of 14% year over year.
And their cash generation is phenomenal. They produced $2.9 billion in free cash flow. That allowed them to confidently raise their full-year 2026 outlook across the board, pushing adjusted sales guidance up to $95 to $96 billion.
But the number that dictates the entire narrative for RTX is the backlog. They're sitting on a backlog of $289 billion.
That figure requires a moment to digest. $289 billion in signed future orders.
It's massive, and it's roughly bifurcated into $170 billion for commercial aerospace and $119 billion for defense.
Right.
I mean, it's like being a highly sought-after contractor who is booked solid for the next decade. The problem isn't getting the work, it's physically finding the time and materials to fulfill it all.
And from an investment analysis perspective, a backlog of that magnitude provides the ultimate earnings visibility.
Which investors love.
Oh, they do. If you analyze a consumer discretionary company, you're constantly trying to model consumer sentiment, inflation impacts on spending, next quarter's retail trends. It's a guessing game.
But with
RTX, the demand side of the equation is effectively solved for the next decade. The macroeconomic buffers are built in.
Because even in a severe global recession, airlines still need spare parts to keep their existing fleets in the air.
Exactly. And nations do not stop spending on sovereign air defense when geopolitical tensions are at historic highs.
So let's dissect the commercial aviation side of that backlog first. RTX operates Collins Aerospace and Pratt & Whitney. The sources show Collins experienced an 8% jump in sales, driven by a 26% increase in commercial original equipment and a 10% increase in aftermarket.
Solid growth.
Yeah, and Pratt & Whitney saw a 16% jump in sales, with commercial aftermarket surging an incredible 25%. But here's the catch. Pratt & Whitney's commercial original equipment, the new engines, actually dropped 8%.
They attribute that drop to large engine mix, but the real story hidden in these numbers is the massive margin expansion happening in the aftermarket sector.
What's driving that?
Well, if we connect this to the bigger picture, the entire commercial aviation industry is currently paralyzed by supply chain constraints at the major airframe manufacturers. Boeing and Airbus are consistently missing their delivery targets for new aircraft.
which creates a massive bottleneck for the airlines. They are experiencing record passenger demand, but they just cannot get the new fuel-efficient planes they ordered to service those routes.
So their only option is to extend the service life of their older existing aircraft.
Ah, I see.
When you push an aging airframe past its intended replacement cycle, the maintenance requirements scale exponentially. They require more frequent engine overhauls, more replacement actuators from Collins, more avionics upgrades.
It's a completely captive market, and traditionally, the aftermarket maintenance, repair, and overhaul, or MRO, operates at significantly higher margins than the sale of the original equipment, right?
Exactly. Selling the initial jet engine is highly competitive and capital intensive. You're fighting for the contract.
All right.
But servicing that engine for the next 20 years, that is where the true profitability lies. The inability of Boeing and Airbus to deliver new planes is inadvertently driving a massive, high-margin revenue boom for RTX's commercial aftermarket divisions.
The defense side of the business is seeing an equally powerful, though structurally different, surge. Raytheon, the defense arm, reported sales up 18% to $8.269 billion, and their operating profit jumped an astonishing 29%.
The sources specifically cite demand for the Patriot air defense system, the Standard Missile family, and the AMRAAM, which is the Advanced Medium-Range Air-to-Air Missile.
Now, looking at this impartially, completely outside of any specific political lens, we are simply seeing the direct industrial result of global geopolitical instability.
We are. The conflicts in Eastern Europe, the ongoing tensions in the Middle East, and the strategic posturing in the Indo-Pacific have fundamentally altered global defense procurement. Well, for the last 20 years, defense spending was largely focused on asymmetric warfare and counterinsurgency. Now, nations are rapidly pivoting back to near-peer conventional deterrence.
Which means air and missile defense is the absolute highest priority.
And RTX is uniquely positioned there. The consumption rate of interceptors and munitions in current conflicts is vastly outpacing pre-war production estimates.
They're burning through stockpiles.
Rapidly. The U.S. government and its international allies are funneling massive domestic defense appropriations directly into RTX to replenish stockpiles and expand those defensive umbrellas.
That volume leverage is what is driving a 29% operating profit expansion on an 18% revenue increase.
Exactly.
But this brings up the most critical question of the entire deep dive for me. If they have a $289 billion backlog and defense demand is practically infinite, why did revenue only grow 14%? What is structurally preventing them from scaling faster?
The constraint is not capital and it is not demand. The constraint is the unforgiving reality of aerospace metallurgy, specialized labor shortages, and zero-tolerance quality control.
It comes back to physics. The sources actually provide a glaring example of this constraint regarding Pratt & Whitney. The forward-looking statements detail a rare condition in powder metal used to manufacture certain parts for their geared turbofan, or GTF, engine fleet.
This powder metal issue perfectly encapsulates the fragility of advanced manufacturing. The GTF engine is an engineering marvel. It utilizes complex superalloys to withstand immense heat and centrifugal force.
And these parts are often formed from powder metal that is forged under immense pressure.
Right, but if that powder metal has even a microscopic impurity,
Just a tiny flaw.
it creates a microscopic stress riser. Over thousands of flight hours, cycling between extreme cold at altitude and extreme heat during takeoff, that microscopic impurity can propagate into a stress fracture.
And in commercial aerospace, there is obviously zero tolerance for a catastrophic turbine failure.
None. So because of this rare condition, RTX can't just focus on churning out new engines to clear the backlog. They have to institute accelerated removals and inspections for a massive portion of the active GTF fleet.
They have to go back and check the ones already flying.
Exactly. They have to divert highly specialized labor, inspection equipment, and replacement parts away from new production and redirect them toward remediating existing engines.
It's an incredibly costly and time-consuming logistical hurdle.
It proves that you cannot simply software update your way out of a physical metallurgy defect.
You really can't. And to handle these immense physical constraints, the sources note RTX is streamlining its portfolio. They recently completed the sale of Blue Canyon Technologies, which is a small satellite manufacturer, for $620 million.
It is a strategic trim. When you have a $289 billion core backlog to clear, you simply cannot afford to have management attention or capital diverted to ancillary businesses.
Yeah, to focus.
They're optimizing their corporate structure to focus entirely on the physical execution of their core aerospace and defense mandates.
So, synthesizing everything we've unpacked today. We started at the angstrom level with Intel, exploring the incredibly difficult physics of printing ribbon FET
The
transistors.
foundation.
Right. We saw how pushing yields from 65% to 85% and expanding memory bandwidth by 20% is the prerequisite for scaling global AI compute.
Then we analyzed how NASDAQ is capitalizing on that raw compute power.
Taking it to the next level.
Yeah, they are shifting their entire business model toward SaaS, deploying agentic AI to autonomously secure the financial system and utilizing tokenized smart contracts to instantly settle massive capital deployments.
And finally, we tracked how that capital flows back into the physical world, landing on the balance sheets of manufacturing titans like RTX.
Companies grappling with the immense friction of the physical world.
Exactly. Where a microscopic anomaly in powder metal can bottleneck a $289 billion backlog.
It is a perfectly linked chain. The silicon enables the software organizes the capital, and the capital funds the heavy manufacturing.
Which leaves me with one final provocative concept for you to consider. We discussed NASDAQ deploying agentic AI, autonomous agents that don't just follow rules, but actively hunt for solutions and optimize outcomes across a $13 trillion data consortium. And
Yes.
we saw how Intel's hardware advancements are making that AI faster and cheaper to run. So if agentic AI is becoming the standard for managing incredibly complex digital systems, how long will it be until those same autonomous agents are deployed to manage the incredibly strained physical supply chains at a company like RTX?
Oh, that is the ultimate convergence point.
Think about it. Imagine an autonomous AI agent that doesn't just track money laundering, but tracks titanium shipments. It predicts microscopic tooling failures before they ruin a batch of powder metal.
And dynamically reroute specialized labor across a global manufacturing footprint in real time.
Yes. To clear a $289 billion backlog, the convergence of Intel's raw hardware, NASDAQ's autonomous software architectures, and RTX's physical industrial scale, that is the defining trend of the next decade.
The invisible scaffolding of the physical economy is about to inherit a digital nervous system.
That's perfectly said. And that is exactly where we will leave it. Thank you for joining us on today's deep dive. Keep looking past the surface level, keep analyzing the underlying scaffolding, and most importantly, stay insanely curious. We'll catch you next time.